This is Matt Godleski with CapTrust Advisors bringing you this week's snapshot edition of The Pulse. Here's what we're watching this week. Stocks fluctuate around record highs as inflation readings surge and interest rate volatility challenges investors. Equity markets continue to remain near all-time highs with second quarter earnings season kicking off this week. Investors are expecting blowout figures for revenue and profit growth from last quarter as the economy expands at a record pace. Contrarily, bond yields have remained well off their March highs as fixed income markets signal growth may have already peaked. On the economic front, jobless claims fell to a new pandemic low with Americans getting back to work and plenty of jobs available to fill. The New York Manufacturing Index advanced to a record, along with selling prices. Meanwhile, inflation readings and expectations have surged. Consumers now anticipate prices to rise at a 4.8% pace, the highest reading in history going back to 2013. Actual readings from June showed prices increasing at 5.4% from the same time last year. The Federal Reserve remains adamant that inflation is a short-term issue that will be resolved in the coming months. Economic growth has seen an incredible turnaround from last year, with a total collapse in growth reversing to investors now worrying about overheating. This is most evident in bond markets, where bonds have turned from a source of reliable income and safety to a new source of risk in portfolios. Stocks can live with higher rates, and often both tend to rise in tandem. However, a rapid rise in rates can present a problem. Interest rate volatility generally is just as important as the overall level of rates. With investors now questioning the trajectory of inflation and how the Federal Reserve will respond, rate volatility could be here to stay. For the first time in many years, we are struggling with inflation risks and are attempting to understand the distortions in data caused from last year's shutdown. With the uncertainty around inflation and the Fed's future actions, correlation between bond and equity volatility is rising. This could make reducing portfolio risk much more challenging in the years ahead. To be better prepared, an increased allocation to alternative assets as well as more rate-sensitive equities could act as a buffer to sell-offs ahead. Within portfolios, we continue to adjust positions to take advantage of what we believe is a short-term growth scare. While our longer-term estimate is that economic growth will slow back to its trend of around 2% per year, we believe the next 2 to 3 years will see significantly higher levels. If our theory holds, the backdrop should continue to favor cyclical stocks and those companies that currently trade at lower multiples. Fixed income markets would also see a rise in long-dated bond yields, while shorter maturity debt instruments rise at a slower pace, based on central bank policy. This environment also may see an outperformance of international equities, but only if COVID-19 can be brought under control abroad. As always, we remain focused on changing market dynamics and make changes only when appropriate. Thanks for watching.